Good afternoon and welcome to another edition of Facebook Live. This afternoon we're going to talk about how retirement accounts affect your taxes. And everybody knows the benefits of opening up a retirement account. They reduce your taxes on the way in. I mean, if you're contributing to an IRA this year, you can deduct up to $5,500, comes right off your tax return. If you're 50 and over, there's a catch-up provision of $1,000. So again, $6,500 right off the taxes. Married couples can do $13,000. Whether or not it's deductible depends upon your overall tax bracket and whether you're enrolled in a company plan. 401ks, if you're contributing in a company plan, you can actually put in $18,000, take that, reduce your income by that $18,000, and again, 50 and over, catch-up provision of an additional $6,000, you can take $24,000 right off your taxable income. That's the good news. The bad news is when you start taking these funds out, it gets added to your taxable income. So again, you can take it out anytime after 59.5 without a 10% penalty, an early withdrawal penalty. 59.5 to 70.5, the floodgates are open. You can do whatever you want. If you don't touch it, and I think this is a big mistake that people make, they defer these accounts as long as they possibly can. At 70.5, you have required minimum distributions, so you don't really have control over those, and they are going to add to your taxable income, and it has reverberating circumstances. It could make your Medicare premiums higher. It could kick you into a higher bracket. It could make more of your Social Security taxable. So waiting to the last minute to take these funds out of an IRA or qualified plan doesn't necessarily make the most sense either. So a couple things you can do. Number one, manage your withdrawals. Once you turn 59.5, you can withdraw money from your tax-deferred accounts without the 10% penalty. The withdrawals are still taxed as ordinary income. But what I tell people is, when you're in retirement, you have more tax flexibility than you've ever had in your life. Your income may drop, and you may be able to do a couple different things. Take money out of your IRAs at that point, and still keep yourself in a 15% bracket. The second thing you can also do, which I think makes a lot of sense in retirement, is do partial conversions to a Roth IRA. Again, married couples filing jointly can go up to about $76,000 in taxable income, remain in a 15% bracket, and when you factor in their standard deduction and or itemized deductions, and you can go up to about $96,000 before you kick up into that next highest bracket. So when you are retired, look at what your income is, and if you can do some partial Roth conversions, that makes sense on a couple different ways. Because number one, you're going to do the conversion when you're in a low bracket, and number two, when your RMDs do come out at 70.5, they're going to be lower because you've converted some to a Roth. The third thing you might be able to do is invest in a QLAC. A QLAC is a qualified longevity annuity contract. When you do these, you can do up to $125,000. When you do them, that takes the money out of your IRA balance, so you're no longer required to take required minimum distributions from that money. You can defer it for as long as 85 and then set up an income stream from 85 and beyond. The key there, you gotta have confidence you're going to live that long. Fourth thing, rejigger your investments. Another way to lower your RMDs is to use your tax-deferred accounts for bonds and bond funds, and use taxable accounts for stock and stock funds. Again, in non-qualified accounts, if you load them up with stocks, you're going to pay capital gains tax rates, which is 15%. If you have bonds in non-qualified accounts, you're going to pay ordinary income, because again, and the other thing is, stocks have historically outperformed bonds. So if you load up your IRAs with bonds, probably not going to go as quick. Reduce the RMDs. Another good thing to do. Fifth thing you might do, keep working. As you reach retirement, a lot of baby boomers are continuing to work. You're still going to have RMDs when you quit, but if you're continuing to work beyond 70.5, you can defer RMDs. The still working exception in a company plan. So you're not required to take them if you're beyond 70.5 and continue to still work. And then the last thing that you could do, which I know is going to sound foreign to a lot of people, you can donate your RMD. It's called a charitable donation. You can take up to $100,000 from your IRAs and donate it to charity tax-free every year. That contribution counts as your RMD and won't be included in your adjustable gross income. So after years of renewing this popular tax break, Congress made it permanent last year. So charitable RMDs are here to stay. So again, everybody loves the tax benefits you get when you contribute to retirement accounts. Not so much when you take the money out, but there are some strategies you can utilize to minimize that tax bite. This has been another edition of Facebook Live.